Hey everyone, and thanks for jumping back into the macroverse. Today, we're going to talk about the US unemployment rate, how it compares to major bottoms with the S&P 500, and ultimately how it lines up with prior recessions. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. Now, we've spoken a lot about macro indicators over the last several months. We've spoken about how all these macro indicators sort of relate to one another, such as inflation, interest rates, the unemployment rate, what would cause a recession to officially be declared. We've talked about GDP. And in this video, because we now have the US unemployment rate on the website, I just wanted to show it and overlay some of the major indices. So one of the things you may note, and we've talked about this for a long time, is that as the Fed raises interest rates and goes through a period of QT where they roll off assets from the balance sheet, it does provide for a generalized bearish outlook, right? And one of the things that we noted is that things like the S&P 500 would likely go put in a fresh low, and they have even today. I think the S&P put in another low. Prior than where it went a couple of days ago. Now the bottom that it's put in is at 3610, and remember back in June the bottom didn't actually go that low. So the S&P 500 has put in a new low. The Dow Jones has also put in a new low. I mean, a fairly convincing low at that. It's gone well below the prior low over here to the tune of a couple percent or so. So I mean, it's well surpassed it at this point. The NASDAQ is still holding out. It has not yet put in a lower low, although you might speculate it's only going to be a matter of time. But other things like, QQQ, that has in fact put in a new lower low as of today. So we've noticed that a lot of these major indices are putting in new lows. This makes sense given the macro backdrop that we're currently see play out. And one of the things I wanted to do in this video was again talk about the US unemployment rate, how it compares to recessions, and then ultimately where does the ultimate bottom for the S&P 500 actually line up. And one of the things we can do is just go back and look at what happened in prior recessions and what did it take for a recession to be declared. What you may notice, I mean, it's clear as day when you look at this chart, recessions, it seems, are more so a function of the U.S. unemployment rate. And now I know a lot of people talk about, 2 consecutive quarters of negative GDP and whatnot. But if you look at this chart, right, where do you see recessions actually called, right? Where do you see them actually called? You see them called when unemployment starts to go up. Now, from an objective stance, we would look and say, well, 2 consecutive quarters of negative GDP is historically looked at like a recession. But you could also understand why some economists would look at this and say, we're not yet in a recession, because normally a recession is accompanied by high unemployment. That has not yet happened yet, but it is likely coming over the next several quarters. And so it's not that hard to imagine that a recession will be declared as soon as unemployment really starts to get moving. If you go back and look, if we actually zoom in to 2020, you can see that unemployment, as unemployment really started to go high, we in fact ended up getting a very brief recession. We saw that over here as well back in 2008. You can see it over here in the early 90s as well. I mean, also over here, of course, in the early 2000s. And what you notice is that as unemployment goes up, we typically go into a recession. Okay, now this is something that you need to consider a great deal, I think. And one of the statements that I've made, and I just want to use the data to back it up, is that oftentimes the S&P 500 bottoms about 2/3 of the way or so through the recession. Is this always the case? No, it is not. And I just want to show you exactly what I mean when I say something like that. If you go back and look at, say, 2020, you can see that the S&P bottomed before the recession was actually over. So if you waited for the recession to be technically over, you would have missed the bottom on the S&P 500. And during the financial crisis of 2008, you can see that the S&P bottomed in March of 2009 or so, but the recession wasn't really over until June. Okay, if you had waited until the recession was over to start assuming that the bottom was on the S&P, again, you would have been off significantly because the S&P would have rallied from, all the way down from around 676. So by the time the recession was over, it was already back up to about 919. This is an important consideration, okay? I'm going to skip over 2000 for now, and we'll come back to it at the end because it is an outlier. If you go back and look at the 90s, you can again see that the S&P bottomed. This time it bottomed about halfway through the recession. Okay? You continue moving back further. Let's go back to say the 80s. Again, the S&P bottomed before the recession was over, and it actually bottomed at around 102. By the time the recession was over, it was back up to 37. Okay, so really, it had rallied at over 30% or so during that time. So had you waited for the recession to be over, then you would have been buying in about 30% higher. Continuing on, you can continue to look at a lot of these scenarios where the bottom on the S&P occurs usually sometime during the recession, not after it's over. This is why we talk about how markets are forward-looking. Even if you go back to the 70s, in the early 70s, the bottom occurred at around 69 or so. By the time the recession was over, the S&P was back up to 83. And you can see this play out multiple times. I'm not going to zoom into every single one of these, but just sort of maybe pause your video here and look at all these recessions and where the S&P bottomed. Okay? Every single time the S&P was bottoming sometime during the recession, right? It was bottoming during the recession and not actually after it. The main counterpoint, which as always, there's always a counterpoint, I think, to keep us on our toes, because again, nothing is a sure thing. If you go back and look at, say, 2000, you could argue that the recession ended in November of 2001, and at that point, it would have seemed like the bottom could have already been in at 965. The S&P rallied on up, back up to around 1.17K or somewhere around that level. But then what happened, right? Eventually, as you got into 2002, it rolled back over and came back down to less than 800. So out of all of the recessions that we can see on this chart going all the way back to the 1940s, I believe only one of them contained a major bottom on the S&P that occurred after the recession was over. So therefore, it is likely worthwhile to put a lot of weight into the idea that there's a high probability that the S&P 500 will likely bottom sometime during the recession. Okay? Now, you're probably wondering, aren't we already in the recession, right? Is this not already a recession? We've already seen 2 quarters of negative GDP. We might see a 3rd quarter of negative GDP. We'll find out relatively soon. Even if next quarter is positive, it's only going to very slightly be positive. And then we could have 2 more quarters in a row and say Q4 of 2022 and Q1 of 2023, that would just bring up the same argument once again of, is this not a recession with 2 consecutive quarters of negative GDP? I think the main thing to consider is that, and this is what a lot of economists are looking at, unemployment remains low. I think it's going to take unemployment to really start to move up before a recession is declared. Once a recession is declared, we're already likely through most of the downturn in the stock market. This is why a lot of people joke that by the time that the powers that be declared a recession, the recession is already almost over. So for people like us who have been looking at the markets day in and day out for years and years and years, and we kind of see what we think is coming, and we think we're already in a recession throughout all of 2022, by the time that a recession is actually declared later this year or sometime next year, it's going to probably feel like, well, yeah, like we've been in one for a year. Why is it only now coming out that we're in a recession? So to us, it will feel like sort of disingenuous to say that the recession's not starting until 2023, because it has felt like one for a lot of people, at least with regards to the stock market. Where it has not been felt as much is in the unemployment data, right? We are not, and again, I understand there's some counterpoints to that as well. You could argue that the data is manipulated. Sometimes the job reports look better than they actually are because maybe some people just don't want to work, or some people have 2 jobs, whatever it may be. There could be some arguments related to the idea that the data isn't as sound as it should be. With that said, this is what we have to go off of, okay? this shows a pretty clear picture that once we're in a recession, officially, the S&P bottoms at some point during that recession rather than after it, with exception to the year, with one exception, and that is the dot-com crash. Okay, so with all of that in mind, it makes considerable sense to me, anyways, to look at this chart and say, well, unemployment is currently sitting at 3.7%. We're going to get some more unemployment data here in just a couple of weeks, I believe. I can't remember exactly what the data is. I think it's actually less than a couple of weeks. I think it may be like the first week of October. If not, it's I think the second week, but it might even be the first week. This is going to come out relatively soon. We're going to see where the unemployment numbers sit. If they still sit somewhat low, you're likely not going to see any changes in terms of calling it a recession. If they start to go up, I imagine the chatter will increase. And by the time we get into an official recession, sometime, say, either later this year or next year, the downturn in the stock market could already be mostly over. But at that point, we would expect that the bottom, with a certain degree, with a high probability, would occur at some point before the recession is over, because the markets are forward looking, with one exception, as we said back in the 2000 to 2002 bear market. So hopefully these are interesting videos that you can look towards to try to better understand how you want to go on your own investment journey. Of course, I'm not offering financial advice. I just want people to look at the macro indicators for what they are, and to try to look at this as objectively as possible. I'm not trying to input my own bias into it. I just want to say, well, it feels like a recession to me, but maybe it feels like a recession to me just because the stock market is doing relatively poorly, not necessarily because tons and tons of people are out of jobs. We are starting to see headlines come across that people are getting laid off, but arguably the job market remains relatively tight, and it still has not softened up to the point that I think the Fed would like to see it soften up. And Chair Powell has said that plenty of times, that they want to see softening in labor market conditions. They want to see that. It has not really yet happened. And if you think about it, inflation, as long as CPI, so the orange chart, the orange line here, right? This is inflation year over year. As long as this remains high, the Fed is likely just going to keep raising interest rates, right? They're just going to keep raising interest rates. This is also overlaying it with prior recessions. But the interesting thing here is that normally when the Fed is raising interest rates, they're doing it when the stock market is going up, not when it's going down. Now they're raising interest rates while the stock market is going down, which is somewhat of a sobering thing to look at. This does not often happen, that the Fed raises interest rates into a slowing economy. Normally they raise interest rates into a relatively productive economy, one that's expanding, one that's exploding, and then they go too far and then things come back down. Now they're raising interest rates while the economy is slowing down, which they don't really do that. Look at the chart. Right, look at the chart. They usually raise interest rates when markets are doing well, and then they're quick to cut rates when the market comes back down. This is why so many armchair economists have been screaming for the entire year that the Fed's bluffing and that they're not actually going to raise interest rates. Because if you look at the chart, it looks like that would be the case under most circumstances. But as I have maintained for the entire year, these people have it wrong, because they're basically just refusing to account for inflation data. Okay, and remember, inflation can stay sticky. It doesn't necessarily have to come down in a linear fashion. It could come down in all sorts of ways. And in fact, core CPI is still sitting at relatively high levels and has gone up over the last, from the prior month. So these are all important considerations that I think investors should be at least thinking about. That way, if there is further downside in some of these major indices, it should not really come as a big surprise. And that would seem, again, as always, right, over the macro scale, that would seem like the path of least resistance, as long as the Fed continues on with raising interest rates and a QT cycle as the stock market's going down and as the economy is slowing down. That would seem like the path of least resistance. Now, could we have counter trend rallies that take us back up? Well, of course, and we've had plenty of them. If you go look at the S&P, we haven't really had any shortage of counter trend rallies during this bear market. Okay, I mean, there's really no shortage of them, and we've had plenty of them along the way. And there's no reason to assume that the next counter trend rally, whenever it occurs, whether it occurs off these lows or whether it occurs off future lows, there's no reason to necessarily assume that that means the bottom is in. What I'm looking for is the Fed's response, and their continued response. I'm looking for where interest rates continuing to go. And as you can see, according to CME Group, if I refresh the page just to get the most recent data, markets are currently saying 62.5% of another 75 basis point rate hike, 37.5% of another 50 basis point rate hike, and they're still thinking that they're going to raise in December as well. And by June, markets think that the Fed funds rate is going to be somewhere between 4.25% all the way up to about 4.375%. So with the highest probability, right? The highest probability is going to be a Fed funds rate of 4.75% by June of 2023. And listen, I know a lot of people don't think they're going to do it, but to Powell's credit, as I've said all year, he has been very transparent about what they're going to do. He continues to do it. People continue to say he's not going to do it, and then he does exactly what he said he was going to do. And then people get upset about it, right? But I mean, if you're listening to what he's saying, he's been completely transparent for basically for the entire year. Obviously last year, I think some policy mistakes occurred, but this year you could look at it and say, well, we're paying the price for what happened last year, and we're likely going to be paying that price for quite some time. So the key thing in all of this is to not let the market grind you out, where you get to the point where you just no longer want to look at the stock market again, because history shows us that you really should not bet against the U.S. economy over the macro scale. Can we have nasty bear markets? Yeah, we can, and they can be brutal. Sometimes they can last for years, but we usually come out the other side, and we usually ultimately trend higher. In terms of trying to identify major bottoms, I think we need to be keeping a close eye on the unemployment rate, what the Fed's response will be if the unemployment rate starts going up. Hopefully, by the time unemployment starts going up, inflation comes back down. Because if unemployment goes up while inflation remains high, I don't really know what they can do. I mean, maybe they would scale back the interest rate hikes, but they don't want inflation to become entrenched. And Powell's been adamant about that literally every single meeting, that they don't want it to become entrenched. And in the last meeting, he even went on to say that there's a lot of potential paths they could take to fighting inflation, but that the one they do take will be the one that is ultimately successful. So I think he's gone the entire year now, tuning out the noise of critics saying that they won't raise rates, and here we are sitting at a Fed funds rate of 3.25%, to the surprise of a lot of people. But again, if you've listened to what he said, if you even watch this channel, right? I said a long time ago, I think the Fed funds rate is ultimately going to reach 4 to 5%. Before all of this is over. That's my base case, and I do think we're going to make it there. And now we just need to keep an eye on unemployment data to see when does it start going up. And the other thing that you might want to note is that if you look at the actual unemployment rate, you can see that the stock market tends to bottom before unemployment peaks, right? So stock market bottom, unemployment peak. Stocks bottom here, and then unemployment peaks just a bit later. Again, over here, stocks bottom, unemployment peaks. Stocks bottom, unemployment peaks. You can see this time and time again. And normally the end of the recession occurs right around the time the unemployment peaks as well. So look, guys, the data's there. The macroverse is something that you should pay attention to. And this is why there are a lot of people that continue on with the bearish bias, because they look at the macro indicators and they think that, well, unemployment rate is going to start going up at some point. We're going to be in a recession. People are going to start losing their jobs. The stock market will probably bottom sometime during that recession, and then we'll come out of it. Let's just hope inflation comes down before that time. Thank you guys for tuning in. Make sure you subscribe. If you're not subscribed, give the video a thumbs up. We also do have the free Into the Cryptoverse newsletter. You can sign up for that. The link is in the description below or in the pinned comment. And of course, we also do have Into the Cryptoverse Premium, where you can access this chart as well as a lot of other charts as well. Not only on crypto, but also on the macroverse and also on equities too. And you can find a link to that also in the description below. Thank you guys for tuning in. I'll see you next time. Bye.